The threat of a stock market collapse is still present. Because of 24-hour news cycles and the relentless barrage of social media, every speck of information appears to be a compelling excuse to start trading shares in your retirement or brokerage account. From the jobs report to disease outbreaks, you might think that even a cup of coffee or a trip to the restroom might jeopardize your plans for early retirement. The powerful truth often echoed in financial circles is that making a lot of money, whether in the stock market or in industry, does not necessitate a high IQ. It needs ruthless cost management, a regimented schedule, and a commitment to doing the right thing in the long run. It entails sticking to what you're familiar with or your circle of competence. The formula for success hasn't changed in years, and it doesn't appear to be changing anytime soon. I invite you to keep on watching until the end of the video. Don't skip any part of it because you might miss out on a lot. So let's get into it. Before I tell you how to make money during a stock market crash, let me tell you what causes it first. To put it simply, frightened sellers cause market crashes. Panic is triggered by an unexpected economic occurrence, disaster, or crisis. The market crash of 2008, for example, started on September 29, 2008, when the Dow fell 777.68 points. At the time, it was the biggest point decrease in the New York Stock Exchange's history. When Congress refused to pass the bank bailout bill, investors panicked. They feared that, like Lehman Brothers, more financial institutions would fail. Crashes typically happen at the end of a long bull market, when excessive exuberance or greed has pushed stock prices to unsustainable levels. This is known as a bubble. At that point, the prices are higher than the company's true value as calculated by earnings. Recent crashes have been exacerbated by a new technological advancement known as quantitative trading. To exchange stocks, quant analysts use mathematical algorithms and computer programs. Individual investors, greed, and panic have all been replaced as triggers of crashes by program trading. For instance, on May 6, 2010, there was a flash crash. In just a few minutes, the Dow dropped nearly 1,000 points. Owing to a technical issue, quantitative trading systems were shut down. Crashing markets will result in a bear market. This occurs when the market falls 10% beyond a correction, resulting in a cumulative loss of 20% or more. A recession may also be triggered by a stock market collapse. Corporations use stocks as a major source of cash to manage and expand their companies. Corporations' capacity to rise is harmed if stock prices fall sharply. Firms that do not deliver would finally have to lay off employees in order to remain afloat. Workers who are laid off spend less. A decrease in demand translates to a reduction in sales. There will be more cuts as a result of this. The economy declines as the downturn progresses, resulting in a recession. In the past, stock market crashes preceded the Great Depression, the 2001 recession, and the Great Recession of 2008. Here are 5 rules for making money during a stock market crash. 1. Buy into good businesses. Purchase stock in companies that produce real income and attractive returns on equity, have low to moderate debt-to-equity ratios, higher gross profit margins, shareholder-friendly management, and at least some franchise value. Good companies do better under pressure, making a turnaround more possible even if the stock price drops by 75% or more. 2. Follow a formula. Buy and sell at fixed prices and specified sums of money to dollar cost average into and out of your positions. This will allow you to avoid buying or selling a spot at the top or bottom of the market. Since you'll never be able to time the economy, stick to a normal strategy of stock accumulation or liquidation. 3. Reinvest your dividends. Reinvesting your dividends would boost your dollar cost averaging strategy. Jeremy Siegel, a renowned finance professor, has shown time and time again that dividends reinvested are a significant part of the overall wealth of those who have made their fortunes investing in the stock market. 4. Watch out for fees. Keep your expenses to a minimum. Most actively managed mutual funds paid a 0.67% management fee in 2018. An index fund, on the other hand, simply buys and keeps a portfolio of stocks designed to track a certain index, most commonly the S&P 500 or the Dow Jones Industrial Average. A low-cost mutual fund or ETF could cost as little as 0.10% of assets every year, or $100 for every $100,000 invested, with virtually no maintenance cost. Take the case of a 25-year-old who puts in $10,000 into a savings account. In 40 years, she intends to retire. At 65, the $10,000 would be worth $57,435, assuming a 6% annual return. Her total fee cost $1,698 if her expense ratio is 0.1% and $9,197 if her expense ratio is 0.58%. Consider this: the same fund with just marginally lower expenditures will provide you with an additional $7,500 in after-tax retirement income without ever touching your portfolio. Most investors are unaware of the importance of fees since they are withdrawn directly from the mutual fund. In other words, they don't have to write a check, so out of sight, out of mind is the case. Every penny you save in fees, especially during a market collapse, will increase your ability to weather the storm. 5. Have a backup plan. Finally, develop backup cash generators and income streams to help you grow your fortune while Wall Street is in a slump. One of the most important things you can do to will the risk is to do this. Even if you make $300,000 a year as an attorney or $2 million a film as an actress, knowing that you aren't relying on your next paycheck to sustain your standard of living would make your life far more enjoyable. Consider Warren Buffett's Berkshire Hathaway wealth model, which employs a two-pronged approach to wealth accumulation. This strategy makes accumulating the first few $1 million of net worth much simpler. In turn, you work off your day job and use your monthly paycheck to finance your retirement. Then you build additional cash generators to add to your investment portfolio, such as car washes, retail stores, newspaper routes, a summer lifeguard job, patents and royalties, and a rental house. That way, when you're going to work, picking up the kids, holding staff meetings, and filling up your car with gas, your cash generators are putting money into your brokerage, retirement, and other investment accounts. This will help you save decades on your journey to financial freedom, as well as protect you if you lose your work. Consider Warren Buffett's businesses. Even if Duracell went bankrupt, he will still be wealthy because Berkshire Hathaway owns Geico. And if that fails, he still has Nebraska Furniture Mart. There's always Benjamin Moore and Company, the paint company, if that gets ruined. He could still fall back on Ben Bridge Jeweler if that was taken away. Also included are Kraft Heinz, Fruit of the Loom Companies, Borsheims, and Brooks, a sportswear company. All of this began more than 70 years ago with a paper route that provided him with his initial money. Consider the small contingencies you should start incorporating into your financial strategy right now. You'll be better prepared to tackle a stock market collapse if you fund your savings from a variety of sources. What not to do in a crash. Don't succumb to the urge to sell during a market crash. Trying to catch a falling knife is akin to catching a falling knife. Individual investors would be forced to sell at rock bottom rates if the stock market crashes. That's the exact opposite of what you should do. What is the reason for this? In the months following a crash, the stock market typically recovers its losses. When the prices rise, buyers are hesitant to purchase. As a result, their losses are locked in. If you sell after the crash, it's unlikely you'll be able to recoup your losses. Selling before a crash is your best bet. What are the signs that the economy is going to crash? There's a sense of urgency that I have to get it in now or I'll miss out on the money, which leads to hurried buying. However, the majority of buyers end up buying at the market's height. They are motivated by emotion rather than money. Protect yourself by rebalancing. As market dynamics adjust, rebalance your portfolio. If you've done your job correctly, you've sold stocks as they have appreciated in value. Continue rebalancing involves buying stocks when the prices are down if the economy does enter a recession. You will benefit from the upswing in stock prices as they rise again, as they always do. Note that the easiest way to shield yourself from a crash is to rebalance a diversified portfolio. Even the most experienced investor has trouble recognizing a stock market collapse until it is too late. Investing decisions made during a market downturn would have a long-term effect on your investment returns. However, many people lose money, often a lot of money, during a stock market crash, but this does not have to be the case. In a declining economy, you can benefit handsomely if you make the right decisions. The reality is that neither the economy nor the future can be predicted. However, you must plan to ensure that you remain on track, if not, improve your investment efforts. As we have reached the end of our video, please tell us in the comments below what you think about today's topic, and moreover, what are your past experiences regarding investing in the stock market? Please don't forget to like this video, subscribe to our channel, and hit the notification bell to always stay updated. See you all next time.